Let me ask you a quick question. If the estate tax exemption is set to drop by half in 2026, what are you doing right now to protect your estate? For most people, the answer is nothing. And that could be a multi-million-dollar mistake. I'm John Farrell, estate planning attorney and founder of the Farrell Law Firm here in Marietta, Georgia. In this video, I'm going to explain exactly what the estate tax sunset means, who's at risk, and what steps you can take today to protect your family's wealth before the window closes. And if you're new here, welcome. I post almost daily videos just like this to help families protect their legacy and avoid expensive legal surprises. So if that's something you care about, go ahead and hit that subscribe button now. Let's get into it. So what is the estate tax sunset? Back in 2017, Congress passed the Tax Cuts and Jobs Act, which temporarily doubled the federal estate tax exemption. Right now in 2025, the exemption is $13.99 million per person. That means a married couple can pass almost $28 million without paying a dime in estate taxes. But on January 1st, 2026, unless Congress takes action, that exemption sunset. It cuts back down to around $6 to $7 million per person adjusted for inflation. So here's the problem. If you've built up a business, real estate portfolio, investments, or life insurance policies that push your estate over that threshold, your family could be facing a 40% tax on the excess. That's not a typo, 40%. Now you might be thinking, that's only for the ultra wealthy, but don't be so sure. If you own a successful business, if you've bought property that's gone way up in value, if you have life insurance or retirement assets, you could easily cross that line, especially as the exemption drops in half. Even if you're not quite there yet, this sunset makes now the perfect time to plan ahead. Here's what you can do right now. Let's talk strategy. If you're concerned about the sunset, here are 3 powerful steps to consider before 2026. Number 1, use gifting strategies while the exemption is still high. The current exemption is use it or lose it. You can transfer assets out of your estate today using irrevocable trusts, family partnerships, or outright gifts, and then lock in the higher limits before they vanish. Number 2, set up a spousal lifetime access trust. This is one of my favorite tools for married couples. A SLAT allows one spouse to give assets to an irrevocable trust, removing them from the estate, while still giving the other spouse access to the funds. It's a smart way to keep some control while shrinking your taxable estate. Number 3, review your existing estate plan now. If your current plan was built when the exemption was high, it might not work the way you expect when it dropped. That includes trusts with outdated formulas or plans that unintentionally trigger taxes under the new threshold. So here's a quick recap. The estate tax exemption is dropping in 2026 from $13 million to about $6 million. If you wait until it drops, you'll lose the chance to shift wealth under today's more generous rules. Strategic gifting, irrevocable trusts, and proactive updates can make a huge difference, but only if you act before the clock runs out. Still not sure where you stand? That's exactly why I created this channel. I've also put together a free resource that walks you through the estate planning process. It's called the Complete Estate Planning Guide. You can download it right now using the link in the description below. And if you found this video helpful, do me a favor, like it, subscribe, and turn on notifications so you don't miss next week's video. I'm John Farrell with the Farrell Law Firm in Marietta, Georgia. Thanks for watching. And remember, estate planning isn't just about avoiding taxes. It's about securing what matters most, your family's future.